This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we will dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, will Europe's gas price lull outlast the rebound in Asian LNG? Plus, we take a look at the global internet sector as AI is expected to become a key growth driver. But first, the easing of labor-associated headwinds and improved demand for care should propel hospital operators to new heights through 2023. For more on this, we're joined by Bloomberg Intelligence healthcare analyst Glen Losev. Glen, thanks so much for joining us here. Talk to us about the hospital business, because, man, were they slammed during the pandemic. Where are we today in terms of their relative health from, I don't know, a staffing perspective, a demand perspective? What are you seeing?
Right. The biggest tailwinds that sort of started in November of last year were the easing of labor overhang, demand for nursing, and also the accelerating demand for care.
Yep.
At the point where the nursing demand will continue to ease through the end of the year, which will continually benefit hospitals' profitability. And care demand is accelerating now, but there is a possibility that it will sort of slow down towards the end of the year.
But just, I'm thinking about the hospitals, images of them just completely overwhelmed during the pandemic. Have they redone how they do their business? Have there been any fundamental changes in how a hospital operates today versus maybe pre-pandemic?
Fundamentally, I think what pandemic did is allowed hospital operators to sort of manage costs better.
Okay.
And otherwise, I don't see any changes.
Okay, so now is it kind of back to normal, does it feel like, in terms of how they operate day to day?
It is.
Okay.
Obviously, there are headwinds still because nursing demand is still elevated relative to the pre-pandemic levels, but it's easing off of sort of the highs of 4Q of last year.
All right, so what have the stocks done? Just give us a sense, really, since the pandemic and to today. How have the hospital stocks traded?
So hospitals, the low for the hospital operators was on March of 2020. That's when CMS issued sort of to kind of cut any
right. Oh, I see what you're saying.
Care demand.
The stuff that generates revenue.
Right.
Okay.
So, but since then, I think in May of 2020, CMS lifted those recommendations and care started to slowly come back. Now it's sort of on par with the pre-pandemic level and accelerating because people over the last 3 years during the pandemic have not really or have postponed getting surgeries and stuff like that. So we are getting to the level where we were at pre-pandemic levels.
So as I look forward, what are the key drivers as an investor I need to be comfortable with when investing in a hospital?
So hospitals are basically just like hotels.
Okay.
There are occupancy levels and cost per or price per occupancy. So obviously, there's always an overhang from what the Washington will do. Is Washington going to cut reimbursement rates for Medicare patients? So that's something that is always in the back of investors in hospital space. Also occupancy, something, and labor. It's probably the biggest cost line for the healthcare providers. So, depending on where it's trading, if it's trading down or up, that's what sort of drives profit.
So in this country, in the United States, are we over-hospitaled, under-hospitaled? Do we have enough hospitals? Where are we in that?
So it's very difficult to pinpoint it because in the urban areas like New York, we're probably over capacity in a normal environment. But, rural hospitals are struggling. There's not enough beds in rural areas. So it sort of all depends on the market that you're looking
So what changes that? I mean, is that just if I'm in a rural area, there's just not enough demand to support a hospital, or there's not enough?
Actually, demand could be enough. It's just reimbursements are not enough.
Reimbursements from
Commercial payers, from Medicare payers. Medicaid pays very low rates. It's about 86% of what the costs are.
Okay.
So the commercial is the driver for the profitability or for the revenue growth for hospital operators.
So if you're a rural person, you just have to drive farther to get to healthcare.
Much further.
Okay, that's the challenge. All right, great stuff. Our thanks to Bloomberg Intelligence healthcare analyst Glen Losev. Let's turn now to retail, where the divide in demand for retail real estate could be more pronounced in the coming year. For more on this, we're joined by Bloomberg Intelligence REITs and consumer hardlines analyst Lindsay Dutch. So, Lindsay, talk to us about the demand for retail real estate. Is there really a story of growing a footprint?
Yes. So it's really an interesting time in retail real estate in that we've seen demand strengthening since the back half of 2020. And what we're really seeing is a shift off mall to sort of suburban centers. And for a while, that has basically been fueling an increase in occupancy nationally. But as we head into next year, rent growth is going to be a key driver. And I think we could start to see the demand really shift from being an occupancy improver to a rent growth driver.
So give us a sense just kind of where we are with the whole, I guess, landscape for retail real estate.
Sure. Yeah. So obviously the U.S. has been oversupplied for many, many years heading into the pandemic. There is still no new supply coming online in the retail world, and expanding retailers are really looking to fill space in open centers where they already can see how productive the center is. And I would just give a quick example. You know, we have some store closings from Bed Bath & Beyond.
Yep.
And sort of the rent upside that we are hearing on those boxes, which are about 30,000 square feet, junior anchor boxes, can be in the 10 to 30% range for these bigger landlords that own high-quality properties.
Really?
Yes.
Interesting. So, I mean, I guess the story, you know, listening to you and others in the retail space really for the last decade or two was shrinking the footprint of retail real estate across the country. Is that story kind of played out? Now it's more of a, I guess, kind of refiguring it, rethinking it?
Yeah, so for a while when everyone was focusing on online shopping, you know, there was a shift in dollars from, you know, investing in stores and store growth to online platforms. Now the retailers know that, you know, when they close a store, they also lose the online sales in that area. And so the brick and mortar footprint has become very, very critical to future growth, whether that's sales in the store or online. So we've sort of seen expansion for most retailers, and the commentary that we've heard coming out of like a major leasing conference in May is that demand is very, very strong, even though retailer results this year are under significant pressure and there is pressure on the consumer. But national retailers are really still focused on expansion and making sure that they're growing in the right spaces.
All right. So how have, I guess, these commercial real estate REITs done? How are they performing?
So performance about year to date, you know, they are underperforming most other sectors except office, which is also facing, you know, significant structural challenges in demand. So there is, you know, some headwinds when we think about valuations on the retail front. But that's why going into next year, when that rent growth becomes a little bit more visible, you know, I think, you know, investors could become a little bit more confident. There is uncertainty in the sector this year that's sort of holding back some of the valuations in terms of we're not really sure if there could be more store closings. And so that's sort of weighing on the sector. There's also has been little clarity when it comes to asset values, and that might be holding back some of the valuation.
Yeah, because we haven't seen a whole lot of transactions, and this kind of goes for, you know, I think about commercial real estate in some of these big cities. We haven't seen a lot of stuff change hands, so we don't really know the magnitude of the decline in value. Is that also true in your space?
Exactly. So broadly, transactions came to a halt sort of in the fourth quarter of last year. They still have not picked up. In retail, we have seen, observed cap rates have risen a little bit, showing some decline in the asset values, but the bid-ask spreads are still too wide. Not a lot of transactions are occurring. There really needs to be a lot more sellers recognizing decrease in asset value with higher interest rates, and we're sort of waiting for that to come. We did see one big public company M&A deal announced. Regency Centers is buying a smaller peer. It's about a $1 billion deal. So that was more of strategic in nature, and I don't think it really reflects that the transaction market is back.
All right. Really appreciate getting an update there. Our thanks to Bloomberg Intelligence REITs and Consumer Hardlines analyst Lindsay Dutch. Coming up on the program, we'll take a look at the priorities of regional banks as they emerge from the effects of recent bank failures. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Following recent bank failures, regional lenders are operating with a defensive mindset, with priorities including building capital, supporting the deposit base, and reining in lending. For more on what to expect as the year progresses, we're joined by Bloomberg Intelligence senior U.S. regional banks analyst, Herman Chan. Herman, I guess I want to start with, is there a credit crunch? Are we seeing banks pulling back lending to their customers?
Right. So I would say there's not a traditional credit crunch, but at this point, banks are pulling back on the edges. And what they're really pulling back on is non-relationship lending. So if you are a customer at a regional bank and you have your deposit there and you want to get a loan, more chances than not you're going to be able to get a loan. But if it's a relationship that's not deposit-oriented or there's no fee income attached to it, chances are you're going to have to pay up a lot in order to get a loan from a regional bank.
Any sense of how long that kind of environment lasts?
Yeah, I think it's going to last for a while. We need some more clarity in terms of the regulations that are coming for the regionals. So that's one. Maybe some more clarity in terms of what happens with the economic conditions if there's a recession coming along. So that's two. So there's some open-ended questions of what's going to happen over the course of the next 12 months for regionals. But we need answers from those two before regionals really operate more on a normalized footing.
Well, it seems like the very fact that we haven't spoken to you as often as we were a couple of months ago, that implies to me that the stress that we did see for a handful of regional banks is kind of behind us.
Right. We
kind of have a better lay of the land. Banks aren't failing left and right. Not that they were before, but not that some banks really have some challenges. Why is it still tight out there for these guys? Why are the stocks not performing well? Why are people not feeling better about the regional banks?
So you're right that we call it that acute stage that happened in March and April. That stage has passed at this juncture. And now it's more of a question of how far does profitability decline for the regional bank space? And that's really focused on margin compression. We talked about deposit pricing rising as banks try to keep their deposit balances on the balance sheet. That's one. It means that there's softer lending as there's actually not only the supply of loans that we just talked about, but also the demand from customers seems to be waning a bit. So that's putting a lid on growing the balance sheet. And it's about increasing your capital because they know increased regulation is coming very soon. So all of those things point to the fact that earnings are coming down for the group, and just to what extent is going to be the question that everybody's looking at now.
All right, so just summarize for us what you think the regulations that may be coming for these banks.
Yeah, so there's going to be two prongs to this. So there's going to be increased capital for the regional banks, so including unrealized losses in the securities portfolio. That's one. Increasing the liquidity regulation, so potentially keeping more cash or high liquid securities on the balance sheet, that's two. And increasing the debt stack for the regional banks, including more long-term debt capital on the balance sheet will be three. So those are the three areas that we think will with announcements coming from the regulators over the next few weeks and months.
All right, you put all that together. What does that do for the return profile of a regional bank stock, kind of pre-reg, post-reg?
Yeah, so that's a good question. Returns on tangible common equity is what we look at. That's, if you can talk about maybe like a 15% ROTCE is pretty good across the cycle. It probably lops potentially 100 basis points or so off of returns going forward, but it really depends on how fast we get back to a normalized environment, both on interest rates and in credit quality.
So let's go to deposits, because I know that's another area you told us to really focus on. So what has been the trend for deposits? I can go out and get a 2-year treasury at 4.65%. I can probably get a CD north of 5%. What's going on with deposits?
Yeah, so what we've seen is deposits have really stabilized, and how that's been stabilizing is that banks are paying up. So you can get a CD, you can get a high-yield savings account with a 5 handle today, and banks are competing against the money market funds that continues to garner record levels of balances week after week. So you've seen banks have to pay up to be able to retain these relationships, and paying up means weaker margins and weaker profitability.
All right, so let's go to that. The earnings, have the earnings been reset on the street for this group, or do you think there's more room to go?
Yeah, so the regional banks have been participating in an investor conference this past week, and a number of them have guided to weaker net interest income and weaker earnings due to the fact that of the issues that we talked about, paying higher deposit costs and weaker lending. So that's starting to become incorporated into estimates, and we expect that to happen further as we get closer to the end of the quarter.
All right, so Herman, in one of our previous discussions, I framed out a scenario where I'm a banks analyst at a hedge fund, and I want to go into my PM and say, I need some capital because I want to go out and buy these bank stocks. I want to buy some quality bank stocks. The baby's been thrown out with the bathwater. Is it time yet to do that, or do I still need to be patient?
I think that if you have a longer-term horizon, this is a great time to potentially look at some of these attractive valuations. They're still trading about 1.1 times tangible book value, which is low by historical standards. And there's some high-quality names out there that, as you said, we're throwing out with the bathwater.
So one of the things that I've learned during this whole process that you've known for your entire career is that we have a lot of regional banks out there in the United States, north of 4,000 regional banks. Do you think, A, we need that, and B, if we don't, will there be some consolidation in this group?
Right. Banks have been consolidating over the past several years, and that will continue. So that 4,000 number will continue to shrink over time. That being said, the regional banks are a key tenet of the communities that they operate in. And so they lend to local businesses and communities and local projects. And that really creates credit and creates prosperity for the communities that they bank with. So that's something that is inherent within the fabric of the United States. So we'd expect them to continue to do that. Just the amount of them will be less over time.
And, and I go into some towns and I see banks I've never, ever heard of. They're super, super local. I don't know if you call them community banks or what. Are those good places to put your money in? Are they needed in the local banking system?
Right. So those are the ones that I think could see some consolidation over time because they maybe not have the scale to compete and offer all the bells and whistles of not only the JP Morgans and Bank of Americas of the world, but even the regional banks. The regional banks have a very similar product set versus the largest banks. And there is a big differentiation versus that product set and some of the smaller that are just really within one or two type of communities. So those community banks will continue to see some consolidation in our view, just to gain scale and be able to compete with the larger institutions.
All right, so in terms of getting back to normal, we're not there, but can you see the light at the end of the tunnel?
I think so. I think once the market digests the weaker earnings power across the group going forward, that will be helpful to get to a more normalized valuation. And also, if we get a recession that's more mild in nature, that will help things going forward. So there's uncertainty there. There's uncertainty with regulation. So of those three issues, I think once you get past all three, things could be more stable going forward.
All right, Herman, thank you so much. Our thanks to Bloomberg Intelligence Senior U.S. Regional Banks Analyst Herman Chan. Coming up on the program, we'll take a look at the global internet space as digital ads get a boost from generative AI. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. Generative AI could become a catalyst for higher engagement and higher ad targeting in the digital space, something that could help buoy profits for the internet industry. For more, we're pleased to welcome Bloomberg Intelligence Senior Technology Analyst Mandeep Singh. Mandeep, I keep talking about AI and generative AI. I'm not sure if it's a real thing, but everybody tells me it is. What's your view of generative AI as it relates to some of the big internet companies that we know and love?
I mean, in my mind, internet companies really own the largest amounts of data that's out there. And, you know, we know ChatGPT was trained on open internet data. Guess what? Google has a lot more proprietary data. Meta has a lot more proprietary data. And all these social networks, essentially, you know, when we are talking about large language models, they have the most proprietary data to train these large language models. So if anything, it will be incremental to their business model in terms of ad targeting, ad pricing. And we're actually seeing that this year. The pace of negative revisions has slowed, and we know these companies have cut costs. So overall profitability outlook has improved considerably compared to where they were at the beginning of the year.
All right, well, how about let's start with just the whole business of search, and we're talking about Google there. How does ChatGPT and just AI in general, it seems that, you know, first blush out would be a competitive threat to Google. How do you view it?
Which it is. So I think when it comes to search specifically, yes, ChatGPT will hurt Google's ad volumes. What Google has done well, and I'm sure we'll see it, you know, as we go through the year, is they will continue to launch more and more products, and they will keep layering generative AI to everything they do, whether it's on the YouTube side, whether it's their own ChatGPT equivalent BARD. And we know the demo wasn't great, but they will keep making improvements simply because they have the best data sets that's out there. And we know generative AI is driven by large amounts of training data.
All right, just across the digital advertising space here, is there still a place for some of these smaller companies? I'm thinking Snap and Pinterest and Roblox and things like that. Is generative AI, is that a positive for them, or is that maybe a negative because there's just so much investment that needs to kind of gear up?
Yeah, so you're right, Paul, that with generative AI, you need to have a lot of upfront CapEx. And so what the smaller companies will do is to leverage the public cloud vendors. I mean, in Snap's case, they have actually integrated ChatGPT as an assistant within their app, and they will continue to rely on the larger players, partner with them. But at the same time, Snap also has a lot of proprietary data. So does Roblox. And any company that has first-party proprietary data is in a good spot. Think of, you know, the software companies. Software companies don't have a lot of proprietary data. So I would say for generative AI, internet companies are better positioned because at least they have their own data along with the open internet data that's out there.
So when we talk about some of the big internet names, the Metas, the Googles of the world and so on, they've really kind of changed their tune a little bit in the last year or so and really focusing not on kind of growth at any price or any cost, but really looking at their cost structure. And I'm not sure if that's a long-term move or just a one-time thing to get their stocks up. Talk to us about kind of how they're viewing costs and profitability.
Yeah, that's a great point. And it's very obvious in hindsight that they overhired during the pandemic phase. So this was really course correction for pretty much all the companies out there. And look, with these companies, their incremental margin is north of 50%. So every dollar they save in terms of fixed costs, it's going to add up to the bottom line. And that is where investors get very excited about the profitability prospects of these companies, because once the top line growth returns, and so far, the expectations are these companies may grow mid to high single digit. If we're talking about low to mid teens top line growth, that's when you will see all of that contributing to the bottom line. And that's where, these companies have a lot of operating leverage, unlike your Uber, Lyft, and DoorDash, where the variable costs really hurt, the operating leverage. And I think that's where you could see some negative revisions. And that's an area where we haven't seen much negative revisions, but there isn't much leverage in their business model either.
All right, so you follow, again, kind of the big internet companies, media companies, the e-commerce, the rideshare, the Ubers of the world, as well as the online travel thing. Where are you seeing some of the best kind of opportunities, do you think? Because, we could be either in a recession, heading into recession, maybe we'll bounce off of the bottom here, who knows? But it seems like higher interest rate environment, maybe a slower growth environment. Where do you think the opportunities are in kind of the sectors you cover?
Yeah, and I think out of the four segments you mentioned, I feel the pace of negative revisions and estimate cuts have slowed in social media and digital ad world. We haven't seen any sort of negative revisions for online travel. In fact, it's been a great environment for the last couple of years because everyone has been traveling. Guess what? The expectations may be on the higher side if you're heading into a recession, and that's where you could see the most negative revisions. Same thing with online delivery and these companies. We've had a very good period of high volume growth and things humming along for these companies. Guess what? If there is a recession, these are the discretionary items, and that's where there is a higher risk compared to the digital ad names, which have done very well in terms of improving their cost structure.
All right, Mandeep, thanks so much for joining us. Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. All right, let's turn now to the European energy market, where ample storage and weak demand have pulled European gas prices near their norm in the first half. But the real question is, will this be overshadowed by a rebound in Asian liquefied natural gas demand? To answer that, we welcome Bloomberg Intelligence energy analyst Patricio Alvarez. Patricio, thanks so much for joining us here. So we went into the winter really concerned about the energy supply for Europe. Just give us a little summary. How did that play out, and where are we now?
Sure. So, as you said, we did enter the winter quite concerned about potential gas shortages as Russia curtailed a large part of the supply that came into the continent, which represented around 40% before the war, represented around 40% of the supply mix in Europe. And that has been curtailed to about 15% of capacity of what it used to be before the war. So, as you mentioned, we had one of the mildest winter or one of the mildest heating seasons in over 30 years here in the continent. So that has been sort of the backstop or the offset to all these curtailments. Although we have seen increased LNG imports sort of also plug the gap, we are sort of also facing quite a frail supply outlook moving forward because we haven't fully replaced Russian gas flows, but it has been a combination of weaker demand both on the industrial side and also on weather that has allowed Europe to exit the winter with ample storage at around 20% ahead of the norm. But what we do see the supply outlook quite frail looking forward because it all depends on both a potential rebound in LNG demand in China mainly over the second half. Demand there has been quite sluggish, but we do expect demand to pick up in the second half as the region tries to restock their gas storages ahead of next winter.
All right, so for the European market, what do they do? I mean, I guess we have to plan for no Russia gas again next year, maybe for the foreseeable future. So are there intermediate to longer term plans to kind of brook that gap?
Yeah, I think the plan so far has been to sort of retain the conservation of demand, which we view as I'd say as a very unlikely thing to succeed over the long run because gas demand in Europe declined over 13% last year, which is unprecedented. It never, even the pandemic, during the pandemic, gas demand dropped by about 7%. So you can see the sheer size of the drop there. We don't think that's sustainable over the long run. But Europe has been very quick in pivoting towards liquefied natural gas, mainly coming from the U.S., although the global LNG market is expected to remain undersupplied or under a very tight supply balance until 2026. And that's just mainly because there isn't much growth expected on the supply front, meaning there's no new liquefaction trains coming online, or at least not meaningfully until 2026.
So are there long-term contracts, like multi-year contract for gas that I can lock in if I'm, a consumer in Europe, longer-term contracts?
Yeah, I think you're hitting the nail on the head with that question, because that has been one of the main problems, or one of the reasons why European gas markets we expect European gas markets to be more volatile moving forward, and that's because the region's energy security plans in the long term see gas demand declining over the next decade. So we see gas demand in Europe declining about 8% through the end of this decade, which makes signing a long-term contract with an LNG producer a bit difficult. And this is in contrast to the long-term contracts in Asia, because Asian demand is about 90% long-term contracted. So that means that Europe will need to outbid Asian buyers if it were to need a little bit more LNG than we pulled in last year.
So, all right, it seems like this is a multi-year challenge for Europe in particular, at least until more supply comes on. So is there a bigger role for the liquefied natural gas industry in North America to help out Europe? Because my understanding is there's not that much more capacity to liquefy whatever we pull out of the ground here.
That's exactly right. So most of the supply growth over the next 2 years is expected to come online in the U.S. mainly, and this year it's mainly from the restart of Freeport LNG, and that's about it. There's a couple of extra sort of expansion on existing trains in the U.S. now, but new projects are only expected to come online in 2024 and 2025, and most of them will be contracted to Europe and other parts of Asia as well. But as you said, it does remain certainly in a structurally tighter supply outlook until mid-decade at least. And in Europe, of course, it has been a combination of weather and also weakness in industrial demand because of the spike in prices last year that is sort of masking this very frail supply outlook, I'd say.
Yeah, because I think I would guess it'd be a fair forecast to say that China's demand is going to pick up going forward, making the market even tighter. Is that kind of how you're thinking about it?
Yes, that's right. So the reopening story in China has come online or has been slower than expected, or at least since versus our initial scenario. But we have seen LNG demand in China start to pick up after the end of March. So beyond, let's say, going into the reinjection season, Chinese LNG demand has picked up, although it has remained below the levels of 2021. So we take that as the benchmark. We do expect LNG demand in China to expand by about 10 to 12% this year, but that's still a far cry from the decline in 2022, which was around 16%. So we don't expect it to recover to pre-war levels, but we do expect it to tighten just on a matter of both seasonality and because industrial demand should pick up eventually.
Can you add more storage to the European market just to try to, get ready for next year?
That's an interesting story that's developing. So currently, Europe has about 110 billion cubic meters of storage, and that has served it relatively well, combined with the new floating regasification facilities that have come online at an incredible speed. So over the past 15 months or so, in Europe, we've seen at least 5 new regasification units come online, which is incredible speed. But at the same time now, we've seen a story by Bloomberg recently pointing out that there may be interest in incorporating or using one of the facilities in Ukraine, a huge storage facility in Ukraine.
All right. Very interesting, complex situation. We appreciate you getting your thoughts. Our thanks to Bloomberg Intelligence energy analyst Patricio Alvarez. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.